Good afternoon, and welcome back to another edition of NCIA's Industry Essentials Educational Webinars. I'm Brian Gilbert, and I'm thrilled to kick off another episode of NCIA's Service Solutions series today, presented by FundCanna and Safe Harbor Financial. In today's program, experts from cannabis-focused financial institutions, FundCanna, Safe Harbor Financial, and AVANA Companies will dive deep into the current state of cannabis lending with leading industry journalist John Schroyer. Learn what may change in the coming 6 to 12 months so you'll know how to access debt capital most effectively in this ever-evolving environment. No matter your place in the industry or the supply chain, from cultivators, manufacturers, vendors, suppliers, distributors, and even retailers, this conversation will provide the insights you need to meet your financial needs. All right, enough with the intro. I see the panel has joined us here. So why don't we kick things off? With that, I'd like to turn it just right over to our esteemed moderator for today's session. We are here joined by senior reporter with Green Market Report, John Schroyer. So welcome to the virtual stage. Welcome to NCIA's Industry Essentials Educational Webinars. I think this is the first time since last year that we've actually had you participating as a panelist. So really appreciate your continued involvement and spearheading today's conversation. So with that, I'll turn it right over to you, John, to introduce the panel and dive right into the program.
Thanks, Brian. And everybody listening, thanks for being with us. Welcome to Service Solutions, Show Me the Money, the current state of cannabis lending. And today with me, we have Adam Stettner, the founder and CEO of FundCanna in California, Sunday Seafried, the founder and CEO of Safe Harbor Financial in Colorado, and Sanat Patel, the co-founder and CEO at AVANA Companies in Arizona, a trio of really fantastically well-rounded experts in the area of cannabis finance. So without further ado, let's dive right in. Let's start talking about equity versus debt is one of the first topics that we wanted to hit on, especially since a lot of companies, a lot of entrepreneurs have been having trouble finding equity investors in recent months and over the past year-ish. Give or take. So that's kind of the big question, is whether or not startups and other companies should be looking at perhaps debt financing yet. Who wants to start that one? I'd love to get everybody's thoughts on that.
Let me start that, John, and thank you everybody for joining, and we appreciate the opportunity to speak to you all. Startup capital into form of debt, specifically in the industry of cannabis, is challenging at best today. And the reason is because of a slew of factors. Well, A, the federal issue, B, the limited resources around it, and how lending institutions, alternative debt funds, or even regulated institutions can lend on startups. Typically, when startup financing has been done for non-cannabis business, banks or lending institutions have been able to rely on the Small Business Administration or other associations like that. That is not available in the cannabis space. So specifically, startup debt is very limited. If it is accessible, it's probably going to be only on real estate. But then even in that situation, John, the borrower would have to come in with a pretty hefty equity contribution and demonstrate to the lender that they've got resources to make the payments while they get operational and get to be, and also have the startup capital for whatever the monthly burn rate is. So startup debt is pretty hard to do. What I think is more accessible is equity. And again, that could come in the form of initially from friends, family, and of that side of it, or equity investors. But debt on itself, it's very challenging at the front end.
Sunday, what's your take on equity versus debt when it comes to cannabis companies being able to raise money?
Well, I think you said it, that the market's kind of drying up at this point in time, and it's difficult to, having just gone through that, it's difficult to go out there and raise the equity necessary, and it's getting a little more expensive, but so is debt getting a little more expensive in this rising rate environment. So I think it's what you can get and what you're willing to give away in order to get that. Although I think most companies prefer to go the debt route than giving up equity.
And Adam, I know you have a slightly different take than Sanat in particular. What's your perspective on equity versus debt?
Well, first I'd say there was a little bit of focus on startups. So I would say For startup businesses, debt, I agree with Sanat and Sundy there. Debt is not a great solution for pre-revenue business. And the main reason I'll say, just forgetting all the complexity behind it, it's hard to know what someone is able to repay if you don't know what their revenue stream looks like. So if we just think of it in that way, whether I'm the borrower or whether I'm the lender, before I have revenue, it's very difficult to determine what is affordable or serviceable. But let's then look at operating businesses with revenue, equity versus debt, and the concept of equity drying up. Even just to be true to your question, even in an environment where equity is available, I would stress that it's very important that that operators think about the real cost of equity, not just from a dilution standpoint, but is equity coming with strategic input? If you're taking on a partner in the form of equity, not only are you diluting your ownership and your other equity holders' ownership, and you can never get that equity back, that ownership back, but because it's so expensive in the cost of dilution, it's really important that if you bring equity in, that you're also getting strategic input. Now, what I would say is clearly with a bit of admitted bias, I always think debt is better, even for myself and the businesses that I've operated. I prefer debt over equity for the reasons I gave. Once you give that equity away, you can never get it back. I view debt as the ultimate form of capital because it's like the ultimate business partner. They fund you when you need the money, and when you repay them, they go away. And usually with equity, they want some kind of input into how you run the business. The beauty of debt is you bring the capital in, as long as you have a margin that is above the cost of that debt. It's a very wise way to operate or grow your business. They have no input, they have no say, and when you've repaid them, you still retain the same amount of ownership that you did before you brought that debt on.
And also, I think it'd be great for each of you to talk about what companies and executives should be prepared for, and what they need to do to just have all of their T's crossed, I's dotted before they actually go speak to a debt provider or an equity provider, either one. Sundy, can we start with you on that in terms of just what bits of advice you'd offer someone who's preparing to take on either debt or equity?
Sure. Since I'm more in the banking side of the house here, I'll speak to the fact that having a compliant bank account is really important. If you are hiding your business in several different financial institutions, it's not going to fare well for any kind of debt provider at this point in time. So having your bank accounts in order, having everything very transparent, and really being able to talk how you're compliant, I think that's really important in terms of protecting anybody who's giving out debt. They will want to know that you are in the business, stay in the business long-term, and compliance is at the top of that list. I have to say, though, having said that, I've never run into too many companies in the cannabis industry who don't know how to talk compliance. It should be one of the first things coming out of your mouth in terms of providing comfort level to your lender.
Adam, what's your take on that? What should companies do to just prep for capital raise attempts, whether debt or equity?
So I'll build on a bit of what Sundy said. First is a bank account. Although going back to the legacy days of cannabis, it was an all-cash business. There are nearly 700 banks that service the space now. There really isn't a reason that a cannabis business should be operating in cash. They should be a banked entity. There isn't a lender around that will fund or provide debt to an entity that isn't properly banked. And then, of course, compliance is very important, active license and the like. But the other thing are the basics. And it's really just having organized financials and bank statements, understanding what the use of funds will be and your ability to articulate the same. And having really and this is more just for the operator, not how they present themselves to a potential lender. They should have an understanding of, when they bring the debt back, what that repayment looks like. You know, the cadence of repayment, the frequency of repayment, what those payments look like, and how that plays into the inflow and outflow of capital for them, so they can determine for themselves comfort in their ability to service the debt or repay the debt. The last thing that anyone should do is, just because the money is available doesn't mean they should take it without sensitizing their ability to repay and how that repayment may affect the business, of course, in conjunction with how the money will help their business grow. But so again, bank account, financials and bank statements, and then use of capital.
So not same question. And also, are there any perhaps red flags that you've seen from folks who have approached you looking for capital or anything like that, that maybe you saw and was kind of an immediate no or yes?
Yeah, no. Piggyback on what Sandy said as well as what Adam said. I think compliance, record keeping, understanding what your cash flows are very important factors. I think to add to that, knowing your business operations and seeing what could happen if the projections you present to your lending partner are not realized. Stress testing it, as Adam said, sensitizing it to look at, hey, what's a real case, a best case, and a worst case scenario. And then in the worst case scenario, what is the likelihood of being able to make repayment? Can you make the interest payment? If you can't, what is your strategy as a management team to cut expenses, to sustain the business or keep it viable? Those are key factors in that regard as well. You asked the question about red flags to look out for. This falls under what I say the compliance bucket. Record keeping as it relates to tax payments, making sure your taxes are current, not using I know we've seen several businesses where they use the non-payment of taxes as sort of the working capital until they can get to obligated. Well, any lending institution will tell you the federal government comes first, and then we all come behind that. And then when you layer cannabis on top of it, we are not even behind the federal government. We're far behind whatever they decide the rules are and how you may have violated those rules in the business. So we as a lending institution really focus on that. And that's a function of character as well, John, because if you're keeping current on your taxes, you're keeping current, your credit history is good, you're compliant, you've got good record keeping, and you've got good financial records, then those are the basics of what a good loan would look like. When if I could liken it to when you're applying for a home loan, you go and provide all the regular things that you need to do for check and balances that then they can approve you for a mortgage, which is a set product. Similarly, in lending on cannabis, not saying mortgage, but that you have to have the same basic principles and make sure that you've got those in order when you go to approach an institution. And knowing a business plan, whether you're in business for a year or a couple of years, whatever, and having a business plan that says, this is what we did, this is how we projected and how we performed against it, and now this is what we're going to do, and here's best case, worst case, real case. That gives a lender some confidence that you know what are some of the nuances of your business.
Absolutely. And to piggyback a little bit on the same theme too, is there anything that any of the audience members listening in today could do to perhaps improve their credit worthiness before they try and take on either debt or equity? What do you think, Sanat?
I think to complement my two panelists, what they said, compliance and record, getting your financial records in order, those are the two basic tenets that I would say they need to do right off the bat in order for us to start looking at it. And I think, if you're thinking, if you're in a growth mode, then you're looking at what you're going to use the capital for, how that will impact your business, and going forward, those are factors that you're going to have to be able to demonstrate and scenario it out for the lending institution to move forward with in that sense. So compliance and record keeping are the fundamental foundation points of any kind of cannabis loan, or any loan really at the end of the day.
Sandy, what do you think about any ways that cannabis companies or entrepreneurs could go about improving their credit worthiness before they maybe approach Safe Harbor or another institution for some capital?
Well, I think when we were actually getting ready for this, we discussed this at length, that the place that any company shouldn't be skimping on money is good accounting and good CFO and good CPA help all the time to make sure. There's nothing better that gives a bank or a credit union comfort than knowing the financials are being managed at a high level and that they're reliable. I think that'd be the one thing I'd say.
Adam, what do you think? How about any tips for improving creditworthiness for folks?
So the separate, without repeating what's been said, I agree with all of it. I think a familiarity with inflow and outflow of an operator's cash flow, and comfort that the money that they're going to bring on is either an accelerant for growth that will lead to an ability to repay, and or that current cash flows support repayment. That's it. It sounds a lot less formal than what's been said so far, but as an entrepreneur and operator myself, and this isn't the first business that I've run, ultimately it's really important that I am introspective and I reflect on what I'm trying to do and my ability to support a project. In this case, if you're taking debt on, the ability to repay. The reason I say that as a way to improve your creditworthiness, although I realize it's not something that leads to a higher score, if you can articulate both use of funds and your level of confidence in your ability to repay, it does go a long way in the underwriting process or the closing of that facility. And so I would just say, take the time to reflect on what you're trying to achieve, how the money will help you achieve that, and your level of confidence in your ability to repay. Make that part of that package that you submit. At least at FundCanna, it's a very limited requirement for documentation. We don't require a lot. But one of the things that is unique about every cannabis business is they all have a different story. They're all trying to achieve something that is unique to them relative to their business plan. The ability to articulate how the capital helps in that goes a long way in improving their approval rate and their creditworthiness.
And just since we're on the topic of debt, and because this has come up in some of my own reporting recently, I know that interest rates have gone up pretty significantly this year as well. As I mean, the Federal Reserve has raised interest rates as well. I'd love to get each of your thoughts on that and how that has played into just the industry at large, and what you know of kind of where debt rates are currently. Adam, what are you seeing as far as interest rates?
So I would say, look, capital markets are crazy right now. It's insane, right? We've had the Fed has met a number of times, 5-6 times. They continue to raise rates, highest rates we've seen since I think 2008. They're meeting again in the next couple of weeks and likely will raise yet again. We've seen mortgage rates go up 200+% from where they were just 6 to 8 months ago. So things are crazy. So let's just put that out there so that we can say, I don't want to act as if things don't feel unusual, because they are unusual. Now, having said that, hopefully everybody that is on this call and many of the people that we all consider colleagues in this great industry, we're in it for the long game. And ultimately, whether it's the rates oscillating or legislation, we're all in it for the long game. And so as it to answer your question directly, John, pertaining to rates, from our perspective, our cost of capital has not gone up tremendously from where we started, because of the industry we're in. I think that this industry drives all of us, regardless of what side we're on, to basically pay a premium because it is illegal at the federal level and because it is deemed riskier than non-cannabis businesses. We all pay slightly higher rate on the capital. And so given where we started, we haven't seen much in the way of penalty associated with Fed rate increases. Now, having said that, I can't say that it'll remain that way forever, but our rates have remained relatively stable, and we're working very hard to keep them where they are. In fact, with the flexibility. And what I mean by that, John, is cannabis has a very unique timeline from cash outlay to revenue. And I think it's important that when you're considering debt, you take that timeline from cash outlay to revenue into account, and you think about how you can turn the money repeatedly, rather than just thinking about this question of what's my rate. Now, I'm not skirting the rate question. I would only say that cannabis is unique in the sense that we have a 2 to 8 month cycle, depending on where someone is in the supply chain. And if if debt capital is used properly, you may be able to turn money 2 to 4 times annually while paying an annual rate. And that, in essence, enables you to generate excess margin above the rate, regardless of the things we can't control, like Fed raising rates. So it's really how you use the money is a good offset to what the Fed is doing with rates.
Sunday, I'm curious, and Sanat as well. What are you both seeing as far as interest rates for debt lending? Have those gone up, stayed stable?
I'll start, Sunday, if you want to join in. The Fed has indicated that they're going to meet a couple times. They're going to meet again in November. It is forecast that the markets are baking in anywhere between 75 basis points to a point type of a raise on the rates. And then potentially again in the first part of the year to see if they've really tamed this inflation beast that they're trying to tame here. At the end of the day, lenders do risk-based pricing. And Adam's point in terms of the cash flow cycle plays very well into that pricing strategy, because if your cash flow cycle is longer, that means the risk period for the lender is much longer. If it's shorter, that's much easier to manage, because if you're turning your cash every 6 weeks, then I know what I'm putting out today will get paid back 6 weeks from now. I'll be able to turn it, 6-7 times a year. But if I'm putting cash here today, and it's going to take 8 months before I see the revenue that you're going to sell from your product for you to come back and pay me back, then I'm out that 8 months. And there's a lot of things that can happen from month 1 to month 8 that could impact the repayment ability of that. So rates have a function of playing with the risk spectrum that you're thinking about. Typically, cannabis is anywhere between, I don't want to pigeon myself box myself into a hole here, but I want to say, if conventional pricing today, bank-based pricing, mortgage rates today are in the 5 and 6% rate. This is consumer mortgages, okay? Commercial mortgages tend to be 200-300 basis points higher than that. When you take cannabis on top of that, depending on the type of business you're in, whether it's a quick cash cycle business or a long-term cash cycle business, it could be anywhere from 400 to 100 basis points above those rates, basically. And that's depending on if it's collateral or no collateral, what type of strategy you're employing. So it has a spectrum of what the debt can be. There's a range of what the debt could be from, but it's pretty much in the double digits, I would say. But I want to be able to caution here and saying that's a function of what the Fed does on the rate and how much capital is available for this industry segment. That capital funnel, if you think about it, it may have been larger in 6 months, a year ago. It has in itself shrunk as well because equity investors have stepped away. Fewer debt people are in that space as well. So it's a function of all of those factors play into it. So it's hard for me to say to you, hey, it's this rate. And I'm sure all the audience wants me to quote that, but I'm not going to do that because then it's misinformation at this point. And I'm just being very upfront about it. I'd rather say, be ready to understand your rate, what the lender will quote you. But then your question should be, how did you come up with that based on what factors led to that decision? What risk factors do you see in my business? And then the next question should be, what could I do to maybe potentially help you offset some of that to drive that cost lower if I could do that? And then that's one side of it, John. The next side, if it's project specific, it's a certain growth cycle, it's a certain equipment piece, then those things have a different pricing structure by itself. And that can be different. That's lender specific in that sense as well.
Sandy, would you like to add anything about the rate fluctuation and all the everything that Sanat and Adam just had to say?
Yeah, I'm not afraid to pigeonhole myself in here. But putting it in simple terms, it just historically, we've been putting loans out anywhere from 8% to 14%. And it really does depend on what the collateral makeup is there. A simple real estate loan is going to be on the lower end of that if it's really collateralized by real estate, and that's it. But as you get to the other end of that, if you're asking for a little working capital, if you're asking for some construction capital, it's going to get more expensive. So I think it's based upon the collateral package. I know there's other risk factors there too. And Sanat is right there behind me, always helping with the underwriting. So I'm not too worried about getting the pricing right. But I think the rising rate environment certainly is going to impact the businesses. But I think what's also happening out there is it's the market's being squeezed. People are starting to withdraw from just normal commercial underwriting. So I think the industry will feel that as well. But what I've always said is that cannabis does have an advantage there because, we've seen them perform during the worst of times, like during COVID and shutdown, and they continued to grow and thrive. So it's almost like a recession resilient product. So that's the good news for cannabis companies going out to seek debt.
And actually, Sunday, I'm going to stick with you for a second because we got a follow-up that's already in the Q&A. It is one of the attendees mentioned that one of the comments from one of our panelists earlier that, quote, "There's no reason to not have banking." This person says that's not as easy as it sounds, and just love to Sunday for you to expound a little bit more on your thoughts on that.
I actually thought I answered that, but I may not have done it right. And hit the
no, you did in the class. Just wanted to give, spread it out to the whole audience.
Yeah. It's not that it's just not easy. It's not inexpensive. And I think that's key. I think that you can shop around and find those 700 banks. The problem is banks are getting in, banks are getting out. We saw just recently 3 banks exit inside of the last month. And why are they doing that? They're doing that because the regulatory pressure is too great, and the BSA pressure, the bank secrecy regulations, are too expensive if you do it wrong. So regulators have gotten much better trained in terms of how to manage cannabis portfolios in a financial institution, which means the more trained they are, the more difficult they give their financial institutions in terms of an exam. And a lot of financial institutions don't want to do that. Just even in our case, as we went to market in 8 years, having 16 state and federal exams when normally you would have had 6. How many financial institutions want to sit through that type of scrutiny? I will tell you that, I was on the brink of losing a lot of my senior management because the scrutiny was so difficult. So then it comes down to expense. And I know the cannabis industry would like to be treated like normal commercial accounts, but the fact of the matter is we file over 1,000 reports a month. And that is expensive to file reports because it takes human labor. It's not all something that's cookie cutter that you can just automate, because the law enforcement looks at these reports and they expect us to put pertinent information per company in each report. So those reports are labor intensive, but then FinCEN guidance also requires financial institutions to do more monitoring, even on lending, where on a lending loan, you might do an annual review. And anything cannabis, you got to be doing a quarterly review of those same things, because you got to be making sure that they're compliant during that quarter. You've got to make sure their license don't expire. You got to make sure there's no violations. All those types of things have to happen in cannabis that don't necessarily have to happen in normal commercial businesses. So it is easier to find a bank account today, certainly, than it was 8 years ago. But it isn't always going to be inexpensive.
Yeah, absolutely. Are there, and just to stick on, so we can close out kind of this general topic of lending, are there any other significant challenges that any of your clients in the industry are facing? So let's start with you on that one.
I think just, what I've seen is a common issues is just the financial record keeping and accounting. Mm-hmm. It's tough because you've got the tax regulation to deal with, and you get different counter advice in terms of, hey, this is eligible as an expense, this is not eligible. And then depending on how you do in your accounting, and then when you approach a lender, they'll look and say, well, no, this isn't, your audit statements show differently. So the accounting record keeping is probably the one where if you can get right, get the banking part right, because all lenders want to be able to take a payment out of an account and know that you're compliant from a BSA and a regulatory, from accounting of your revenue perspective. Then you layer that on with just accounting records in terms of how you're keeping your books and everything to show, from seed to sale, those kinds of record keeping. That's very, very important. Most often when we've talked transaction request, where things come undone is when the record keeping is not accurate, and we see financial statements that are then restated, and that creates a sense of doubt for the lender, because then what am I relying on? Because I'm lending based on your financial records, and then I need to be able to rely on your accounting of that being accurate. So Sunday made a point earlier in the conversation saying having a good CFO, having a good accountant, those are probably, if you had a checklist, bank account, check, good accountant, check, a good CFO, or at least a CFO that you can rely on, check, you have those. That's probably now give you some basics to go talk to a lending partner or even any kind of a financial institution to say, hey, this is what I'd want to start to do.
Sure. Adam, are there any other lending hurdles that any of your clients have run into that you think would be worth?
I think the aside from what's already been said, who you work with is very important. So I think some of the stories that we hear from our client base prior to arriving at FundCanna is bad experiences elsewhere. So applied for lending, commitments were made, we sprung into action to execute on things, believing that the lender was reliable, and then either terms changed or money was pulled or the facility was resized. So I think one of the challenges in actually receiving the money is a function of who you work with, their reputation, their experience, their knowledge, and candidly, just your ability to rely on your lender. I mentioned earlier that debt is like the ultimate business partner. They're only the ultimate partner if you can rely on them. And so one of the challenges, it's not so much getting an approval, it's the execution and what that relationship is like. So who you work with is key.
Sunday, anything to add on that topic?
True story. So recently had a conversation with somebody regarding personal guarantees. And it got a little heated, and, normal lending usually requires, commercial lending usually requires the personal guarantee of some sort. And sometimes people don't want to give their personal guarantee. Well, what not to do is start arguing with your banker that you don't want to give a personal guarantee, because now I'm asking the question in the middle of the conversation, do you think something's going to be difficult about repayment on this loan? You're going to have to get to that personal guarantee. So I think, personal guarantees are something you should expect, but also something that we find a lot of people don't find palatable, but it's not outside of normal commercial lending. I think I'd like to just make that point.
Absolutely. Yeah.
Just to piggyback on that point from Sandy's, from a personal guarantee perspective, we asked for it. And the reason we asked for it, it just tells me that you're willing to stand behind your business, because I'm willing to lend it to you, and you're willing to find a way to repayment in the event of difficulty. If you now say you don't need my personal guarantee, that's for me to assess, not for you to tell me. I do my job in lending. You're not going to tell me how to do what I should ask for or not ask for. If there's a definite reason, we'll definitely say, okay, we won't need it. But that's sort of a basic where we start from, because then that tells us, are you willing to stand behind your business? Whether it's a commercial business or a cannabis business, we do it for both.
Sure, absolutely. And to build on something that Adam just mentioned in terms of being careful about lenders that cannabis companies work with, I have no doubt. I've heard plenty of stories about predatory business folks and lenders out there in the industry taking advantage of people left and right. So what advice would each of you have for how folks can go about evaluating lenders that they could or should or shouldn't work with, basically? Adam, do you want to start?
Sure. I think in this day and age, it's very easy to do a little bit of research. We don't have to be private investigators to use Google, and so I I think that looking up not only the company and the company's reputation, but maybe the operator, CEO, CFO, people that are working within the organization, what did they do prior? And what is their online reputation look like? That's just a place to start. And then how long have they been in the lending business? Not necessarily in the cannabis lending business, because our industry is so young, but how well do they understand underwriting files, flexibility, and the ability to fuse data with a story? Because if you've got lenders that are fully automated, relying only on data, they're really not treating you as an individual. And if they're not using data and they're only relying on you, they're probably getting the size of the facility they're willing to give you way wrong. And so I would say that's something. The other thing that I would say is avoid what I call stacking or over leveraging yourself. And this is what I say. It's very important. If you're going to borrow, just because people will give you the money doesn't mean you should take it. And often what happens is, and I'll arbitrary example, but I'll use Sanat and I as two examples here. We're both lenders. If I were to underwrite you, John, as a potential client, I look at your inflow and outflow of capital, I listen to the story, I weigh everything out, I make you an offer, and I am very comfortable as a lender that you can support whatever the debt load is that I provide to you. If you then go also to Sanat and borrow from him, and then after you're done with Sanat, you go to yet a third, what I did to make sure that my facility was comfortable and was within the confines of both assisting your business and allowing you to repay with comfort without it being a burden, you've erased my knowledge, right? So for example, I've overseen lending organizations that combined, we've underwritten over 1 million business files. We've funded nearly 100,000 clients. If all of that is ignored by then drawing from other sources, then, because my power isn't just to control my risk, I want to build a relationship with the borrower so that they know that they can rely on me, that I'm never going to put them in a bad place. And when they need money again, I'm still here for them. So they can draw again and again and build this very reliable inflow and outflow of almost like a revolving line of credit. But if they over leverage or stack on top, it's a huge mistake. So when you talk about what risks might exist, the risk of people saying yes to you and you taking the money without assessing what kind of impact it may have on your ability to repay.
Sure. Sunday, you have any thoughts on how folks can evaluate who's the best lender to match their needs?
I do have a thought. So, one of the things is that not all lenders are all things to all people. And I think that's really important. Even here, if we don't do what Adam specializes in, we're a small community too. We're happy to refer our clients over to Adam for his help because he specializes in particular type lending. I think the best thing you can do is always start with your financial institution with whom you're banking. And if they're not doing lending, then most financial institutions will hand you off to somebody they trust that's doing some sort of lending. So I think that's a great place to start, but also understand we may specialize very conservatively in real estate and, somebody else may do equipment lending. So really, sometimes you may have to have more than one lender.
And I want to pivot now to a pretty different topic, just because I'm watching the clock and I want to be cognizant of how much time we have left to talk about all these various different issues that are at the forefront of a lot of folks' minds. But one of the biggest bits of news that came to the cannabis industry a few weeks ago was when President Biden announced sweeping pardons of federal cannabis offenders, basically for possession. But he also began the process for potentially rescheduling or descheduling cannabis at the federal level. and wanted to get each of your thoughts on what kind of impact that could have on the financial side of the industry, both for lending, banking, finance in general. So Sanat, let's start with you on that. I know that's a really broad topic,
Yeah.
but what are some of the reverberations that you see possibly coming down because of Biden's move?
If the passage occurs and it's decriminalized, then it opens the door for other sources of capital, banking, more traditional banking capital, to really enter the space and not be fearful of how they track it. Now, compliance is still going to be compliance. I think that's not going to go away. So banking institutions that jump in are going to say, I still need you to be fully compliant and all that. But then it opens the door of lending traditionally, very much like a commercial loan would be applied. And some traditional commercial lending metrics can get applied. Initially, you're not going to see much in the change in terms of pricing or anything like that, because as more entrants get into the market of lending, then that's when competition builds, and that's when the pricing will start impacting and pricing will come down. So I think it will be a positive effect, if anything, when this does happen. I doubt very much the large institutions will jump into this space, because the compliance requirements, as Sandy said, it's too great for them, and they've got, while they have distribution, they don't have the back office to support that type of compliance. So you're going to see community banks be more competitive in this space. So I think that's going to open the door. As Adam said and Sandy said, there's 700 banks in the country that do this. There's over 5,000 banks in the country, and 700 is between credit unions and banks we're talking about. And there's about 4,000 credit unions. Imagine now you have 8,000 institutions that automatically can say, I can serve my customer and not face federal regulatory scrutiny. That opens the door for a much better competitive environment. Industry-wide, it will benefit. A greater slew of services will come up for them, and pricing will come down, because with the passage, I'm sure the government will say, here's the basic requirements that everybody has to follow from a compliance perspective. And once those are set, people can adhere to that, institutions can adhere to that, and then move forward that way. So I think it will open the door. Passage, again, that's a crystal ball. I'm not even going to try to answer that question when it occurs. But I do think it will be positive for the industry if it occurs.
Yeah, absolutely. Sandy, what's your take on how this could change? I mean, I know as Sanat just mentioned, nobody really knows obviously what the Biden administration is ultimately going to do on rescheduling or descheduling, or perhaps even leaving it as a Schedule I controlled substance. But what are your thoughts on just how this possible movement could affect the financial side of the cannabis industry?
First, I will go out on a limb, and I will say that I will find it very difficult to believe that we will go 8 years and 7 attempts at safe banking to full legalization anytime soon. I just can't believe that we're not going to be moving through that incrementally. As far as the impact goes, with or without, I think the whole decriminalization is really important. I think that's great for the people who are involved. I think they're already starting to say, though, is it you were a user or you were a seller? And a lot of people are in prison and jail because they just had a certain amount of product on them that they called a seller. So I think they got a lot of things to work out on that particular issue. As far as whether safe banking, anything passes, we're going to see momentum. We already are seeing momentum. We are seeing the pricing crunch on even depository side. Used to be you would have to pay $5,000 or $2,500 just to open an account. And now we get that. I mean, it is way down there to the point where many people are just bypassing any type of onboarding fee because they want the relationship long-term. Same thing is happening in lending. We are seeing more people get into lending. So this is going to continue. Why would they get into depository services? The fact is they've seen us do it and other entities do it for 8 years and not be prosecuted. That sets a standard and a precedent. Why would lenders get into it and financial institutions at this point in time more than those of us that have been doing it? Because of the fact they don't want to lose those relationships. The lending relationship is the long-term relationships every financial institution wants. So you're going to see people pushing in to get that lending relationship and taking on the depository relationship. I don't think it will get easier for cannabis companies as long as there is a black market that is trying to hide right in the middle of, a legalized market. We at the banking level have to sort between the illicit players and the legal players. And that is difficult. And that means it's going to require paperwork, and it's going to require additional compliance. And it's going to be likened to the fact of money service businesses like a casino or check casher, highly scrutinized businesses. So I think, if we just say everything's going to get too easy after legalization, although I already told you my opinion on that, I think what we're going to see is a long-term situation, especially due to the black market and legacy funds that exist in the market that haven't been put into the financial system yet.
Yeah, absolutely.
So,
Adam?
I in the interest of time, I'll try to be brief on this one, although I think it's charged for everybody that's joined us today. This is incredibly frustrating. And I'm not at all being political. It doesn't matter what party or which individual is in office. We've got midterms coming. And I think the timing of this announcement, from just my skeptical perspective as a guy that really cares about this industry and is all in and vested, the timing is suspect. You've got fentanyl is scheduled below marijuana. And we've got people in prison, and we throw out this like cookie of we want to decriminalize at the federal level, right? Decriminalize, but then it's left to all states to handle. And then on top of that, we're going to take a look at how it's scheduled. For me, it's non-committal, and it's really frustrating. So I want to say that minimally, so that everybody in attendance realizes that we're all human and we have the emotion of frustration, and it's been way too long. And this to me is still too little, too late, but it is a step in the right direction. And I don't want my comment to be viewed as negative. I just want it. I want us all to have empathy for the circumstances that we're in here, and realize it is a step in the right direction. I think it's great, but I think at this stage, the vast majority of people joining us and working in the industry that are not on the webinar, we probably all feel as a majority, we don't really know what those announcements mean to us. And what I will also add is, even if this were descheduled, even if cannabis were legal, let's be realists when I say business in America, non-cannabis, dry cleaners, restaurants, contractors, you name it, right? Wherever you go every day, businesses that service you and your family, they're declined by the very banks that they deposit their money into at a rate of 75 to 80%. As small business owners, the approval rate outside of cannabis from traditional banks is 20 to 25%, unless they're pledging real estate. So without real estate, if the approval rate is only 20 to 25% for non-cannabis, we can't really expect traditional banks to look at cannabis and approve them at a rate that is at or above traditional small business. But again, to Sunday's point, there are banks and there are lenders that are servicing this community now and this industry. And as it becomes federally legal and more competition comes in, it will create innovation in product and pricing, and things will definitely continue to improve. We have momentum on our side. It's just, we've got a fair way to go. We just have to stay strong and stay together.
Let me add one thing. I know that was brief, Adam.
I'm passionate. I can't help it. Yeah.
Okay. The one thing I really think will be so disappointing to the industry is, that the health service organization decides to throw a bone out there and say, we're going to reschedule this to a 2. That's just going to be so disappointing because it doesn't take care of any 280E issues for the industry.
I'm glad you brought that up, Sunday. I was going to mention that myself because that's an important point. I think that everyone in the industry should be aware of that rescheduling arguably creates more problems than it solves, depending on where the Biden administration might move it to. But that's a whole other can of worms. We've got a financial question from the audience. We're going to start taking some of these now. Is all three of you, all of your companies and everything planning to offer lending and banking services in New York, New Jersey, and other new markets? Sunday, let's start with you on that.
Actually, yes, and we've already opened an account or two in New York. So we're actually working, to educate state officials and regulators there to make sure they understand how to safely bank this money in New York State. And I just tallied up the states the other day. We are actually taking cash from 28 different states at this point in time. So our game plan is to go out there and serve as many states and as many clients as we can. Many of our clients are over state lines, so that's really how we got to be on this platform already.
Sanut, what about AVANA Companies?
Yeah, no, we are partnered with Safe Harbor, so we do follow in terms of other states that are getting into there. I think the tougher part about the new states as they open up is who are the new entrants? Are they coming as startups? Are they existing folks that were, doing had medical approval, now are getting to recreational? Those are the easier ones to get into because then they've got a business that's a trended, an operating history. That when they become a startup, then it's harder to do. And that, unfortunately, is usually when we see the larger MSOs step into that. But yeah, we are entering those markets as well.
Adam, I assume you're just sticking in California. You're not interested in the rest of the 49 states in the country, right?
Well, actually, I'm not interested at the moment in 11 states because they're not legal. But if a state is legal for cannabis, then I'm very interested in lending. Again, the only restriction being if a state comes online and that business will not have any history. Minimally, if I can get 3 months of track record that just shows revenue, I can begin, even if we build the relationship as revenue grows, after 3 months, I'm very interested in lending to any state.
Okay. Yeah, good one. Another audience question. With the mindset of investors are betting on the jockey, not the horse, what type of CEO or founding team would be a red flag or not a viable investment? Anybody want to take that one?
I can't even get
right there.
Analogy. I can't even get sports analogies right. I'm not taking that one.
Horse racing is a betting person's game. So let's maybe leave that to the casinos to kind of judge that. I think it's when non-cannabis investments are made by private equity companies, they're betting on CEOs and they're betting on management teams that have history, that have gone through economic cycles. That's probably a starting point. That's hard to say because then a lot of cannabis companies today are started by younger entrepreneurs that don't have that experience or doing that. So I think it's really a business plan, a business strategy, your ability to show that you've weathered some storms, or at least show that you've got a path to a repayment, and being able to show some sense, that in the event if I've got a best case, worst case, real case, if I had a worst case, here's how I know I can get myself paid. And then a comment Sunday made, if you have collateral, it solves a lot of problems. But if you don't, then you've got to really be strong from an equity contribution in whatever perspective. So I think it's hard to answer that question just from we don't identify which is the best CEO to do that. It just depends on their business strategy and their business plan, really.
So I'm just going to chime in real quick, John, on the comment I made earlier about making sure that you have your story in terms of how you plan to use the capital, how it will help your business, and your level of confidence in repayment ability. And the reason I say that is because those are all traits of a strong leader. And so it's less like we're not going to do like a personality assessment on the CEO per se, but I actually I'm not a gambler, but I love the concept of betting on the jockey versus betting on the horse. We are all in on the horse. The horse is cannabis industry, right? And so now it's a function, or horses, right? But now it's a function of who are the individuals that are operating the entities within the industry, because you're judged by the company you keep. And so we want to align ourselves with people that are professional, that work hard, that have good integrity and morals. And despite all of the issues that we're all dealing with, right, from 280E onward, how do we handle ourselves? How do we articulate what we're trying to achieve and give confidence to the lender or our financial institution as to what our game plan is? And so I love betting on jockeys. And I think that's a large part. It's part, right? Not all, but it's part of what we do here every day. If there were no jockeys, we're just putting money into horses that are running out of control. So the question that is asked, I think to answer that directly is just have a game plan, right? It doesn't have to be a formalized business plan. Just have a narrative that you can articulate as to what are you trying to achieve? How will the money help you? And what is your level of confidence in terms of how you'll repay that capital and over what time? And if you do that, I think you're way ahead of the game as a jockey.
And another question from an audience member, how can I start to shift my retail company from being primarily a cash-only business?
I'll jump in on that one.
Go for it.
It is a process. We find that it takes about 60 to 90 days for companies to get out of a cash business into mainstream banking once they get a bank account. So once you get a bank account, it's not going to happen immediately overnight, but you get yourself a courier and you get that cash to the Federal Reserve, and usually working with your bank, that's the best way to start there. The second thing is looking at other options, whether it be contactless payments like a Can Pay or an AeroPay or something like that, where you can get that put in your shop, and it really served them well. I'll tell you, when we really saw that takeoff was during COVID, because they had to have cashless payments, and it really facilitated continuity of business at that point in time. So cashless payment options, ATMs, where you're not servicing them, you certainly don't want to service them yourself. And the biggest aspect of going from cash into a financial institution is going to be, what type of cash do you have on hand presently? Many times when we see someone coming in, they've been cash for a long time. Sometimes they have $500,000 to $1 million. And how do you get that money into the financials? Yeah, the first and last time I counted $800,000 was the first month I was in this. But you want to have the records. That's not considered what I would say legacy cash, because it was earned in a legal environment. And as long as you have the records to support how you earn those revenues, your bank should be able to take those easily enough and put them in. So just be prepared to have the paperwork to prove that money was legally earned. That's the difference between legacy and regular sales.
I just have a hard time imagining the gigantic stack of paperwork that you would need to support legally procuring $800,000 in cash. I can't imagine that. Was that like a just stack of papers like to the ceiling or something like that? Or receipts?
No. Actually, the paperwork wasn't, because, the seed to sale tracking systems are so helpful, right? You have a good seed to sale, and you've tracked your inventory, you've tracked your sales. That to me, and you've reported it to the state. So, what are we checking? We're making sure you're not tax evading here. So you reported it to the state, you reported your income, so it matches up with the money. We can validate that money as long as you've got the records to do it. Now, counting the cash was to the ceiling. That was four bank box high. That was no fun.
I bet. Well, that about does it for us. We're a few minutes over time. Brian, I think that just about does it. Is that it for us?
Yeah, I think we appreciate all of the latecomers that joined the Q&A board and really helped contribute to the conversation to keep it going. Apologies for anybody that might have had an appointment at the top of the hour, but like I said in the chat room window, everyone here, as well as the other 40 or so folks that we had pre-registered that weren't able to attend today's session, will receive a formatted video recording probably Friday morning or early Friday afternoon, so they can dive deep and get everything they need to know out of today's conversation. So typically, to conclude, we like to throw it back to all the panelists to provide sort of a final thought and your perspective and key takeaway that you want all the audience members to leave today's program with. So with that, why don't we throw it over to Adam and then Sunday and Sun it.
Thank you, Brian. And thank you for hosting this. And thank you to everyone that attended. I will just say we love servicing this industry. I know things are up and down at the moment, but We'll all get through this together. There is plenty of access to both capital and banking. And when in doubt, you've got three panelists here that are clearly interested and willing to assist. So please reach out to us with questions.
Well said, Adam.
That was brief.
Yeah, all of us. Thank you. No, I agree with Adam. I think life is going to get easier, but nothing in cannabis is easy. As I said in the chat, it's still an uphill battle as long as it's federally illegal and as long as there's so much moral judgment out there, even though we see things moving in the right direction. You know, you really have to have the stomach to get in the industry and the stomach to stay in the industry. And you're right, we've got some long-term players here that are happy to stay with you in that game.
I think well said, Sandy, and well said, Adam. I think in this industry, you've got to be able to learn, have a mindset that's a growth mindset where you have to learn and adapt because things are changing and it's an evolving industry today. But we're looking forward to staying in the industry and hopefully see its growth in the near future. So look forward to helping anybody that's attending in the conference, attending the webinar. So look forward to it.
And John, thank you very much for hosting.
Absolutely. Yeah. Thanks for having me.
Yeah, fantastic. We really appreciate, John, you taking time out of your vacation to join us and work with the panel over the last few weeks to really develop these amazing questions. And I think, like we said before we started the call, I think we have a whole nother webinar that we could really produce with some of the stuff that we didn't even dive deeper into. So as we close out today's session, I'll launch our final poll just so that we can get some additional engagement from the audience members. And in particular, our panel can have as much of a snapshot of your current needs, where you are within the industry, so that they can follow up after today's call and let you know how they can help provide those services and those needs directly. All right. And with that, our panelists why don't we give a big virtual round of applause to our amazing panelists and moderators for presenting today's sessions. Exactly. Yeah. Post those, raise your hand in the audience pool, post those key takeaways that you took from from today's conversation inside of the chat room and pass along that appreciation. Appreciate those comments from Fernanda and Cynthia in particular. So thank you so much. I'm glad you all got a lot out of today's conversation. So with that, our panelists are going to head out into the backstage area. They'll still be available within the chat room for the next 3 to 5 minutes. So if you do have any pressing questions, or you had a question that you wanted to field directly with one of our panelists, you didn't feel comfortable putting it to the Q&A board, find them in the chat room and send them some direct messages and engage with them over the next few minutes while we close out today's session. All right. And with that, thank you all so much for participating in yet again another NCIA Industry Essentials educational webinar. As always, it feels really great to interact with our network in this live format. So we sincerely hope that you'll continue your participation with all these interactive educational opportunities throughout the remainder of the year. We've got a number scheduled for next month, and we're going to be showcasing a number of sessions led by our member-led committees throughout the month of December to welcome the incoming term of new members and showcase all the amazing programs and resources that they produce for us over this last term. I saw at the beginning of the program that a number of you all did indicate that you were not currently members of NCIA. So I would highly recommend that you follow the link that you'll be directed to after today's session closes to learn more about all of the amazing and affordable options for membership with the association. Your contributions will directly impact our ability to continue progressing this issue forward on Capitol Hill and specifically open up access to banking and financial services for all of our members and supporters. If you haven't already, make sure that you are signed up for our weekly Events Digest newsletter. That'll keep you up to speed on all of our activities as soon as they're announced and provide supplemental resources to make the most out of your involvement with these sessions. And then last but not least, do greatly consider applying to sit on one of NCIA's 14 sector-specific committees, of which we're currently in the 2-week application period that is annual. This is the best opportunity that you have to not only join NCIA as the association, but really take your involvement to the next level, working with colleagues and coworkers from across all of these different areas of the industry to develop best practices for us, expand your professional network, and really drive the mission of NCIA forward in all of these different member working groups. So with that, a huge thank you once again to all the members of our panel for presenting today's session, along with our audience members, and most importantly, those member businesses that are essential in driving our organization's mission forward. We'll leave you with this end of event credit sequence that highlights all of the 120 plus companies that joined us for our exclusive cannabis industry lobby days earlier this fall. If you don't see your company listed here, don't be discouraged. That means you just need to head to our website to join and register to attend our 11th annual Cannabis Industry Lobby Days on the calendar for next May from the 16th through the 18th. With that, thank you all so much. Huge thank you once again to FundCanna, Safe Harbor Financial for sponsoring today's session, as well as Sanette and John for joining in today's conversation. We'll see you all next time.